IAS 20 covers government grants and government assistance. The most important thing in terms of accounting for these is really the government grants. And it's one of the few standards where actually there's still some choice in how we apply it. Now, there are two major types of government grants that people receive. Capital grants, which is money towards assets, and revenue grants, which is really money towards expenses, such as wages or marketing and so on. Now, with a revenue grant, it's nice and straightforward. You just match the grant income you receive to the expense that you incur, and it has to go over the same period, really applying that matching or accruals concept. So as you incur the expense, you match the government grant income to it in the same period. There's a minor choice there, but the choice is just presentational. It's you either show the expense net, so if it was salaries that you were putting in admin expenses, you could just net the grant income against those admin expenses, or you could show it as a separate line saying grant income received. But either way, the amount that you record would be the same. A bigger choice exists within the capital grants, which is the money towards the assets. So let's say that I bought a building for $10 million and I received a grant of $1 million towards that. I have two choices of how I would account for that. The first one is I could net the grant off the cost of the asset. So I could say, well, the assets really cost me 10 million, but I got given a grant of $1 million, so it really cost me $9 million. And then I just depreciate that $9 million over the life. So if it was a 10-year life, I'll just have 900,000 depreciation every year. Another choice is that I could use the deferred income method. So I could say, well, I've got the asset, it cost me $10 million. I'm going to depreciate that asset over 10 years, so $1 million expense every year. But I've also been given $1 million grant for that. Now I hold that in deferred income as a liability, recognizing that actually I might have to repay that grant back if maybe I sell the asset or breach the conditions in some way. And I hold that million as a liability, and then every year I release a tenth of that liability into the statement of profit or loss. So I would have a $100,000 income really to offset the depreciation expense. So under both treatments, you would have the same statement of profit or loss expense. You would still have 900,000 as an expense, but the presentation in the statement of financial position would be very different. So IAS 20, really important as you're looking at accounts, decide what type of grant is it and what method are they using. Are they using a deferred income method or a netting off method? Because the presentation in companies' accounts will actually be quite different.